Dori. Welcome to this week's episode of the Silicon Valley Podcast. Now, I'm super excited to have you here. The topic that we're going to be talking about today is very relevant and something that I know post this interview, there's going to be a lot of questions on LinkedIn, a lot of questions emailed to me about what we covered to go deeper. But for our audience out there, before we even start, can you give a little background of your career up until this point?
Sure. Thanks for having me, Sean. Excited to be here, and really looking forward to talking about some of these topics. My background is I've ultimately been an entrepreneur, serial entrepreneur for the majority of my career. Started my first company about 10 years ago. And since then, I've started 3 companies in total. SimpleClosure is the third company I've started. And I've had the privilege of selling a company. I've had the privilege of shutting one down. And I just, went through that painful process myself, which eventually led me to starting SimpleClosure. But I think, the way to think of me is just like I'm a founder. I'm a founder at heart. I've been an entrepreneur and I've been through the ups and the downs. And that's it. That's a bit about me.
Well, question right there. Where did you learn more? The selling a company or winding a company down?
Yeah. It sounds cliche, but you learn so much more from failures. And from preparing a company for shutdown and, the process of going through that and preparing it and asking myself tough questions of like, what could we have done different and what could we have done better? And what would I change if I built the next company? How would it look different? I actually think we learned a lot more than, the successes. And so I'm very, very much a believer that you learn a lot more from failures than you do from your wins.
Now, I'm curious, was the wind down be the first company and then the sale was the second company, or was it vice versa? Was your first company the success and the second one was the wind down?
So it was a bit of combination of all of the above, to be honest. Our first company was actually, I don't know, I don't want to use the word dating, but social networking app, social networking / dating. This was like almost pre-Tinder times. Before Tinder became popular. We ended up building that company, raised a bit of seed capital for that, and spun it down pretty quickly. So we did end up shutting down that company. And I had kind of the first taste of shutting down a company. Although with that company it was a bit different. The company was originally based out of Tel Aviv, Israel. So the process of shutting down was a bit different. And like I said, I spent about a year and a half on that company. But then the majority of the last decade, I spent building the company called Ernie, a consumer fintech company. We had raised $13 million. We had over 3.5 million users in the US and scaled the business. We eventually sold the business about 3 years ago. And it was a decent outcome. But what really got me into the world of kind of shutting down and understanding it a lot more was probably about a year and a half before the sale. We weren't doing so well. I was in a board meeting presenting financials to the board. And one of our board members actually looked at the financial plan that I was presenting and said, hey, Dori, the numbers don't look so good. The runway looks actually really short. We're not going to invest in the company any further. We also don't think it's, you're able to raise external capital from other investors. I think we need to talk about a plan B of what happens if this doesn't work out. And I was totally kind of taken off guard in that instance. And I asked the board, okay, what do you want to talk about? Like, what is there to talk about? What do you expect to see?
Just wondered, did that board member talk to the whole board in advance, or was this kind of just a spur of the moment during the board meeting? Just, hey, Dori, I'm seeing this right now, even though you gave it to us a couple of days in advance to review, and just laid it on you right there. Like, how shocked were you?
Yeah, great question. At the time, the board was we have 4 board members, or it's technically 3 board members and a board observer. So 2 of the board members were us founders. He had definitely not talked about it with us in advance. And then he was the 3rd board member. And then we had a board observer. Had the board member and the board observer discussed it in advance? Maybe. I don't know. And then, like I said, the board observer didn't have a voting right, but we definitely had not kind of discussed it in advance with the board member prior to the board meeting. And so Um, I wouldn't be surprised if that was kind of like, the first time that they had kind of brought it up. Yeah. So probably not. We didn't have too big of a board, where you have like, multiple independent board members and lots of external board members. So for the most part, it was still, a founder led board at that time.
Okay, so they said, or he said, may not be the best thing moving forward, not going to invest more capital. You should think about winding down. And at that point, you just went, I don't even know what to do. Or,
Yeah. So I asked the board, okay, our board member, what would you like to see? What are your expectations? And he said, listen, I'd like you to put together a shutdown analysis for the business. And I'm like, what's a shutdown analysis? He's like, well, I want to understand as a board member, what are our liabilities? What's the timeline? How much money do we need to set aside? Are there contracts we can't get out of? Are there customers we need to refund? Are there severance packages we need to prepare for? He pretty much flooded me with a ton of questions. Uh, and the honest truth is, I didn't have an answer to any of those questions. And so I told the board, hey, let us kind of go do some homework and get back to you. And so I left that board meeting, frustrated, disappointed, probably at one of the like lowest points in my career in my company. And obviously I had to get back to the board with answers. So I literally went to that evening, I went home, I went to Google, I Googled, how do you shut down a startup? Hoping to find a platform or a company, and couldn't find anything material to help us through that process online. I tried to ping founders through my LinkedIn networks that have either been through a shutdown process or going through it currently, to pick their brain and see what they went through. Couldn't find any founders in my LinkedIn. And what I realized really quickly was that it wasn't that founders weren't shutting down. It's founders don't like writing about it or talking about this topic on LinkedIn. It's a very taboo topic. Founders are ashamed of it. It's not something that they are necessarily proud of. And I even went to our lawyer and our accountants, and we were using like a top Silicon Valley law firm at the time. I think we were using Fenwick at the time. And I reached out to our partner. I'm like, hey, I need help with this. And instead of jumping on the opportunity to help us, their reaction was like, oh yeah, we're really sorry to hear. It's not really our bread and butter here at Fenwick. The partner that I was working with had a friend of a friend that had a boutique law firm in Colorado. He's like, let me ask him if he's willing to help you. And so I really found myself at this moment in time when I was like the lowest point, in, like I said, in my company career. I remember asking myself a few times going to sleep at night, I'm saying, am I the first founder in America shutting down? Like seriously, like that's what I felt like. I'm like, no one shuts down. Like no chance everyone else is going through this. And ultimately I had to get back to the board with answers. I kind of rolled up my sleeves, decided to dig into, go headfirst into the world of shutting down. Started speaking to industry experts, learning the difference between an ABC, a wind down, a bankruptcy, a dissolution, a Chapter 7, Chapter 11, like really trying to dive in and get an understanding of what our options are. And actually, after spending a good few weeks, I ended up putting a playbook together for the company, a shutdown plan in a sense. Presented to the board a few weeks later. The board kind of signed off and said, plan looks good. And so that was kind of my introduction to the world of shutting down, my true introduction to the world of shutting down. And like I said, we eventually end up raising a bridge from external investors that helped us get through kind of the low points that we had. We ended up launching a B2B business in addition to our core consumer business. We ended up selling actually 2+ years later, or a year and a half later. But that was how I kind of went through that shutdown experience.
Quick question. Was there anything that you did during that time when you were kind of researching how to shut the company down that, okay, this would extend our runway, or hey, if we got rid of this, we'd be more efficient here or that actually caused you to be able to raise the bridge round and have that exit, or not?
Yeah, look, I think it's a combination of two things. One is when you're with your back against the wall, a lot of times the founder, especially as like a first time founder, to some extent, you find ways to be more resourceful in ways that you didn't think were possible. And so with your back against the wall, with your existing investors not willing to put in additional capital, we were very, very, very aggressive. It kind of drove us to the point to like, okay, we're going to do anything possible to keep this company alive. And that, entailed like extreme layoffs and cost cutting initiatives and things that we thought like, oh, the company can survive if we do this, right? The company survived and it thrived with those layoffs. So I think that's like one thing is it really drove us into a mentality of like, okay, we're really at do or die right now, and we're going to do everything it takes to survive on the financial aspect. And then the other aspect, I think it also, to some extent, pushed our limits and boundaries in terms of like being able to move faster and being able to diversify our revenue and our business model. Whereas like we had, there was a business opportunity that we had postponed because we were like, it was a defocus. And ultimately we ended up launching a B2B business. Our core was a B2C consumer business, but through that, at that moment in time, we're like, what else can we do to drive revenue? And then we're like, okay, let's explore this B2B path. And we ended up launching another business within the company, which was the B2B business. It ended up being the fastest growing revenue line of business in the history of the company. So like we went from like, 0 to $1 million in revenue in a few months in that line of business. And then actually one of our partners, we signed multiple partners very quickly. And actually two of our partners gave us acquisition offers, and we ended up going with one of them, one of our customers that acquired us in the end. But I think that like to some extent being challenged of like, this is the end of the line, where, it's like, you got to figure this out on your own kind of thing. I think to some extent drove a lot of urgency and forced us to think differently. So yeah, I think, and again, back to your point of like, do you learn more from the failures or the successes? Like it was a failure in a sense that led us to shift to focus on this.
Okay, so let's go to, you mentioned a couple of keywords there that I'm guessing the audience not too familiar with, Chapter 7, 11, ABC assignment by creditors and that. But let's go back even further. What are all the steps in a wind down process? Can you walk us through step by step what actually happens?
Sure. That's a huge question. So I'll try to break it down as simple as possible. And tell me if this is too much in the details. But I think like before that, I think what's important to understand is what are the mechanisms to even shut down? Like, what are your shutdown options as a company? Maybe we'll start there and tell me if this is going too deep, and we can jump into more of like what are the
granular. I mean,
okay,
yeah.
So, look at a high level, the way that I think in general, like especially venture capital, we'll talk about venture capital ecosystem specifically. It's a bit different for the SME, but for like a venture capital ecosystem, is look, companies running out of cash. What are typically their options when a company's running out of cash? It typically breaks down into 3 high level options. First of all is raise additional capital. So it's like a bridge round, additional capital, raise another round. And so a lot of companies are like doing everything they can to raise additional capital. The second option is to try to get a sale across the finish line, try to sell the assets, a fire sale, asset sale, acqui-hire, any type of sale across the finish line to try to kind of land the ship or land the plane smoothly. And then the third avenue, in a sense, is like if those two typically fail, or in parallel to trying those two, you're going kind of like the doomsday scenario of like, okay, we're going to need to shut this down. So that's at a high level what we typically see when it comes to like venture-backed companies and how they're thinking about the end of their journey, or like when the timeline's starting to become really, really short. And actually, it's a very delicate dance, because you're actually needing to think about all 3 at the same time, because you're trying to raise, but you're also trying to sell, and you also need to think about what happens if this doesn't work out. And so you're really, as a founder or as a board member or a team, you're like, wait, how do I sell to my investors that we're raising more capital, but I'm thinking in my brain about shutting down, and like it doesn't go together, because you're asking your investor to put in more capital, but you know that you might shut down, and so is your investor investing money into a lost cause? And so it starts to be this like really, really delicate dance that founders and companies, go through a lot. And it's a really challenging one. But anyways, assume that you tried to raise additional capital and it didn't work out. Assume you tried to sell and it also didn't work out. Which, by the way, separate topic, but in asset sales. So in the world of, selling companies, you have asset sale and stock sales. Say the majority of the low dollar amount of sales are typically asset sales. you actually still need to shut down the entity. So that's something that a lot of people don't realize as well. But we can get back to that in a second. But assume you
And
decide to
Dori, also curious, what is kind of the timing for these? I mean, I'll talk to founders and they'll come to me a month before they run out of money and go, "Hey, I need to sell the company." And you're like, "Whoa, that's not possible." Well, when should we're going to go this direction or that direction? When should that actually start? When should those conversations be had with the board or the founding team?
Yeah, look, it's a really, that's what I'm going back to saying when I said it's a really delicate dance, like, because you're kind of doing all three in parallel. And what can you really focus on if you're trying to fundraise and you're just trying to sell and you're thinking about shutting down? Like, you have to navigate. It's a really, really stressful time. I would say, you know, probably a year before you're running out of cash, as a business, like, are you on the right trajectory? Are things going in the right direction? Have you proven enough of the things that need to be proven in order to raise your next round? And I think founders, a year before they run out of runway, they have a sense of like, are they in the right direction or not? If they're in the right direction and they have confidence, like, we're going to be able to raise a round and we're hitting the milestones and like what a series seed or series A or series B requires, then, I think they could think about those other things less. But at a high level, I think about a year before running out of cash, you should have a sense if you're like on the right trajectory or not. And then I would say at around a 9 to 6 months check mark, like, if you don't have full confidence that you can raise a round, you need to be thinking very hard about your options and your alternatives and how much runway you need and how much cash you need. One of the biggest mistakes we see are on the shutting down side. And by the way, you probably see it on the selling side where a company comes to you like a month before they shut down, like, I need to sell you. Like, listen, it's not enough time. Like, we can't properly sell you. And if we do, you're going to get like a penny on the dollar because it's such a rush and such a fire sale. You have no leverage. You have nothing to work with. And so the chances that you'll be able to sell are like for something meaningful are very small. By the way, same thing with shutting down. Some companies will come to you with like, yeah, I have $5,000. I have no money in my bank account. I need to shut down. And then we're like, but it costs money to shut down. What about payroll to your employees, your final payroll? What about your outstanding invoices? What about taxes to the state and the government? Like, we're not even talking about, our fee in this case. We're talking about like, it costs money to shut down. So the last thing we want to see is founders get to a point where they're like, no cash, 0 months of runway, and say, now I'm thinking about this. Because what typically happens is founders end up paying out of pocket, which really hurts. Or their investors, if they're grateful, gracious enough to contribute, they might throw in additional capital to help make sure things are wound down. Because in some cases, they could be personally liable as board members if things are not properly shut down or taken care of. So the honest truth is, I think founders should be thinking about this 6 months before. And there's this kind of delicate dance of like, you're trying to sell, you're trying to raise, and you're thinking about what happens if I have to lay off everyone, and how do I do that in a way that's respectful and gives as much heads up to employees as possible.
Okay, now go back to all the steps. So it's just 6 months, a year in advance, start having that, plan things out. Now, what are those steps that they're planning?
Exactly. So before we get into the steps, I was just going to give the options to shutting down. So at a high level, there's kind of 3 ways to shut down a company, venture-backed Delaware corporation in the US. One is a bankruptcy. One is an ABC, which stands for assignment for the benefit of creditors. And the third is kind of a managed wind down or typical shutdown, call it. Now, in general, I would say 1 to 2% of companies go through a bankruptcy a year. So of the pie of 100 companies shutting down, let's call it 1 or 2 will go through a bankruptcy. Maybe 2 to 3 will go through an ABC, and the majority are going through a managed wind down. For the people that are not familiar, what is a bankruptcy at a high level? It is a process that is governed by the federal bankruptcy courts. It's a very long, expensive, public process. An external party comes in, usually it's assigned by the federal bankruptcy courts. They take control of your company. They sell the assets. They try to restructure it. They might shut it down. There's different types of bankruptcies, but at a high level, you lose all control of the company. It becomes really costly, and it's very public and long and expensive. So that's kind of like a bankruptcy. In between process is something called like an ABC, an assignment for the benefit of creditors, and that's where there's kind of these firms that are known to do ABCs. They've been around for a few decades, but it's kind of like a state level bankruptcy. External firm comes in, they take control of your company. It's a lot faster relatively from a bankruptcy, but it still takes a long time, probably a year or so. It ends up costing typically minimum $100,000 or more. And typically these ABC firms, they won't work with you unless your assets have a ton of value that they can monetize, because that's where they're also making a ton of their money. So that's an ABC. And then the traditional ones are managed wind downs. That's what 95% of the market does. And that's where you're like proactively going and in an orderly way, shutting down your company and shutting down all the different parts of the company. And you asked, what are those steps? So when we talk about a managed wind down at a high level, before we get into steps, there's at a high level 3 phases to it. And these phases mimic Delaware law. And so when I give these examples, I'm specifically talking about Delaware. Every state's a bit different in the type of entity, if it's a corporation or LLC. But for the example, let's just go with the Delaware corporation, since it's the most relevant one for tech companies. The first phase is called dissolution. The second phase is called wind up. And the third phase is called shutdown. And then what that means is, by the way, each one of those have multiple steps in them. So to your point, how many steps? Just to give you and the listeners a sense, there's about at SimpleClosure for your average shutdown, there's about 95 moving steps on average to a shutdown. So that's the amount of moving parts that are
for those 90 steps. Is it the CEO that's responsible for all of it, or is it spread out throughout his whole team?
So it could be spread out across their whole team. Some of it's on the legal team, some of it's on the internal team, some of it's on the accounting team, some of it's on the HR team or HR provider. But what typically ends up happening is when you're going to shut down, everyone has been let go. And all there is typically a founder or 2 left. And so what ends up happening without a ton of cash. So what ends up happening is like, yes, if they had the whole team there and they were all working for the company, it could be spread out. But what typically happens is you have no cash, you let everyone go right before this. And so it ends up all falling typically on the CEO in this case. And that's why the average time to shut down a company for a venture-backed founder typically is 9 to 12 months, because they're spending close to a year doing all these things, figuring it out, going through the process. And that's why it ends up taking so long, the traditional way of doing it. But to your previous question around the phases, so at a high level, dissolution is the first step of a shutdown, where you're notifying the different state agencies about your decision to shut down. You're getting a board resolutions, you're getting shareholder consents, you're notifying the state of Delaware, you're notifying any foreign states that you're registered. It's kind of the first phase. The second phase is the wind up phase, which you're starting to close out all the affairs of the business. You're starting to wind up the business, meaning you're closing out payroll accounts, you're paying contractors, you're canceling vendor contracts. You're dealing with payroll specific things with customers and migrating customers off the platform. You're closing out all your IT accounts. You're really kind of winding up the business. And then the third phase is the phase where it's like, okay, you're done with everything. The last thing to really do is kind of file your final tax returns, close out your EIN. You'll be dealing with distributing any funds back to investors if there was any funds or proceeds left at the end after a sale of any asset, and eventually shutting down your bank account, sending tax write-off documents to your investors for the loss they took. So that's kind of the third phase. And so at a high level, those are the 3 phases, but there's about 95 steps on average that are part of those 3 phases.
And you'd mentioned for bankruptcies that 1 or 2% that go into Chapter 7-11, very expensive. ABC's 100,000 or so. What would be a management wind down? What kind of cost fees would be expected?
Yeah. So I don't know to speak about other companies, but I would say at a high level on our platform and SimpleClosure, the typical cost is usually, again, pricing depends on size and scale of the company, but I would say it's typically around $8,000 to $12,000 for a venture-backed company. And obviously that can go up or down depending on complexity. But that's a fraction of what companies today pay for an ABC of some sort.
And how can founders ensure that employees, investors, creditors, everyone gets treated fairly during a wind down?
Yeah. So that's a great question. And it's actually really important to do it the right way, because if you don't do it the right way, you actually open yourself up to liability. Also, the board members, the founders. There's actually certain things that, if are not done properly, they pierce the corporate veil. So the whole point of having a company is where you're protected or shielded by the veil of company. But if there's certain things that, if you're not done properly, they actually pierce it, and you could be personally liable as a founder, or personally on the hook as a board member for those things. And so, if you're doing it yourself as a founder, how do you ensure? It's hard to answer that question, because you're kind of doing it yourself. One of the biggest pieces of advice I always give founders that talk to us and talk to our team is, look, if you don't want to use SimpleClosure, that's fine, and we respect that. We're obviously here to help. But my biggest piece of advice is, don't do this yourself. This is one of those things where you don't know what you don't know. You only learn that you made a mistake months or years later, usually because you're suddenly get a fine or a penalty or a lawsuit from a previous employee, or a fine from a state agency because things were not done properly. So, if you're doing it by yourself, it's very hard to ensure that you did it properly. So we really, really recommend using professionals for that. And on our platform, that's part of the uniqueness of using SimpleClosure, is we give founders, operators, board members the peace of mind that a company has been shut down properly. We do that by using technology. So we ingest a lot of information from customers during onboarding. We connect to their cap table provider, to their we collect all their certificate of incorporation and their bylaws, and we analyze all that data. We also integrate into public state databases. So a lot of information gets missed when companies onboard to our platform. And so we want to make sure that we've turned every stone, and there's no skeletons in the closet. So that's another way where we ensure that. And we ultimately, that's part of the value proposition of working with a professional, is that you have that peace of mind that you won't have surprises.
Do you have any stories or examples, leaving out names, or it can be hypothetical, of people that you've heard winding down the companies on their own and then having it, come back to haunt them?
Yeah, of course. We have a ton of those stories. Unfortunately, they're really painful ones. But back to your point of making sure that it's done, and I'll connect it to done the right way and connect it to a story. If there's any capital left over in the company, there typically is some sort of capital. That capital has to be distributed in a certain way, in a certain kind of order. And so one of those things is realizing that, first and foremost, payroll and wages to employees is at the very, 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 very top of the stack. So any employee that's worked for the company or is owed wages, they have to get paid first. That's one of those things that we talked, for example, that you could be personally liable for if that actually pierces the corporate veil if wages are not paid to employees. So if you had an employee work for you until the last day, and then you fire them, and you're and you have no money in the bank, but they just worked for 2 weeks, because payroll always goes in arrears. You always get paid at the end of the pay cycle. And so that can be really, really messy. And so payroll's at the top of that. And then usually the taxes and fees to the state agencies and governments. And then above that are secured creditors. So they have rights, first of all, after that class of payroll and wages. And then it goes to unsecured creditors. So any vendors that you owe money to, and only then it goes back to investors. If there's any distributions left, it goes back to investors. And even that is done through a waterfall calculation of, they have a note or a safe, or they're preferred, or they have certain rights. So to your question about examples, we have an example of a founder that spent a good 9 months, probably 10 months, doing the shutdown on their own. This was actually when we were doing user interviews and customer interviews before we started SimpleClosure, and we were talking to a ton of founders. He had shut down everything. He had been done with everything. He distributed capital back to investors. So he even had, I think, 100,000 or so to distribute back to investors. He was done. He was happy. It was behind him. And then about a year later, he got a fine and a penalty for an unpaid tax of $10,000. It was a bit over $10,000. It was the state of Florida that they had owed and had not paid. And so, like, imagine that moment as a founder where you're like, you're already past this, you're ready to work on your next company, or you have a job or whatever it is. You thought you were done with it. A year later, out of nowhere, you get, a fine and a tax owed for $10,000, and you have no capital left. Like, you distributed the capital to investors. And so now they had two options. One was like going back to their existing investors and asking for more capital, but also for investors, it's challenging to do that because they have, their fund and their structure, and that money was used in a certain way, or pay for it out of pocket. And the founder ended up paying for it out of pocket, $10,000+ and it hurt so much, to hear that story and hear what they went through. So that's like a prime example of those horror stories of not following properly the process and ending and making mistakes where end up being really, really, really costly. I have another founder that I know well, that they had not properly closed down their California EDD payroll accounts. And the state reached out probably a year later or so, because they had not properly closed out and paid out the taxes, and put a lien on their personal car. Like, so they pierced the corporate veil and put a lien on their personal property. So those are just like, two examples that come to mind on how, painful it can be.
You'd mentioned earlier in the conversation that even in an asset sale, people are normally not aware that they still have to shut down the company. Can you talk a little bit about either the financial implications or legal, or the differences between an asset sale and a stock sale when winding down a company?
Yeah, sure. So at a high level, there's two different types of sales: stock sale and an asset sale. I'm sure there's different like mergers and reverse acquisitions and all kinds of different complicated or unique structures. But at a high level, those are the two, I would say, most popular ones. For those that don't know, a stock sale, what happens is the buyer comes and says, I'm buying the entire company with its entire cap table and all the stock and all the liabilities and all the value of that company. And so typically when you see a stock purchase, like, here, Meta buys a company for $100 million, like typically those are like stock purchases. And those are typically like the bigger sales. When you think about the smaller sales, they're typically done in an asset sale. What does an asset sale mean? It means where the buyer comes in and kind of cherry picks the assets they want to buy. So they come in and say, hey, I only want your customers, or I only want your code base, or only want your domain, or I only want your team. They come and kind of cherry pick the assets they want to buy. So that's typically an asset sale, and that's done usually for kind of smaller sized acquisitions. Pros and cons: asset sales are usually less expensive to do from a legal perspective than a stock sale. A stock sale is typically more advantageous for the seller because the buyer, by buying the entire company, they buy the liability and they buy all their debt and they buy everything. Whereas an asset sale, the buyer can say, I don't want your debt, I don't want your problems, I only want your good assets, and I'm only buying your good assets. So there's kind of pros and cons to both, and they could be there's obviously like tax reasonings behind the scenes also for a lot of these things. But what people don't realize is the majority of acquisitions, like at the lower end of the scale, like the single millions, maybe single tens of millions of dollars, a lot of times are done as asset sales. And in an asset sale, exactly as we mentioned, the buyer's coming saying, I want this, this, and this. Like, I'm buying these specific things. The original entity still exists and is still there. And so the people that are on the hook for their original entity, the shell entity, call it, like the entity without the assets, are still the founders and the board that had originally kind of started the company. And so what a lot of founders don't realize is that they're actually still on the hook for properly winding that down, making sure everything's closed out. You still have your Delaware registration and your payroll accounts and your state accounts. And so I would say, for example, at SimpleClosure, probably about a third of the companies that we help shut down are companies post asset sales that have done an asset sale type acquisition, and they need help with winding down the shell entity. So yeah, that's kind of the use case, and it's something that founders, that if they're going through a sale, they should keep in mind as well, that they need to go through this process. They need to set money aside to properly wind down, and that they're still on the hook for that.
I'm just kind of curious. Have you ever come across a situation where there was a co-founder that's really no longer involved in the company, but the wind down was done improperly and they're liable and get a surprise of, oh my gosh, I had no idea. Is that ever happened in the past?
I've heard of that come up. Again, with customers that use SimpleClosure, like the whole value proposition is that we make sure that doesn't happen.
Mm.
But as a founder, look, if you're a founder and you still hold a board seat or you still hold like a decent amount of shares, you are part of the process. You're signing off on the approval of dissolution. So you need the board to approve, and you need the majority of shareholders, typically of a certain class, to approve it as well. So if you're a founder, you're probably in the loop and you're probably also aware of it. But typically in the process of shutting down, there is someone on the team that is assigned to be, call it the wind down manager, the person in charge of winding down. And so they're the one that's usually like dealing with it and is dealing with the communication post shutdown. But I don't think I've come across. I mean, I will say that the case where there was a personal lien on the assets for that company that didn't shut down their California payroll account, it was for all founders. So anyone that was an officer at the company, the lien was on them. So it's kind of a thing of like the states and the agencies, they will take a look at who has historically, who historically has been like an officer or a director at the company. And I think that like what I've seen is they come back to everyone equally. They don't cherry pick who they come to. Everyone kind of has a shared liability from that perspective. So come to think about it, in that California case, all the founders were kind of on the hook for that.
Interesting. And just a couple more questions. I'm looking at time. I'm wondering, what's the best way to talk to your board about, if you're looking at going, you know what, it's in the right, and we're not going the direction we're supposed to go. What's the best way to talk to them? What's the best way to talk to, the core team of, hey, I know we've been heads down for the last 2-3 years, but reality is we might have to shut our doors in the coming 6 months here.
Look, it's a great question. It's really, really tough conversations to have, both with your board and your team. I actually don't know which is harder. They're hard in their own ways. We have a few articles on that on our website, actually, like best practices of how to approach the board and the employees and how to let them go. I think my take on this is, the more transparent, the more upfront you can be, the more I see it actually works in your favor. And so I think like the worst horror stories we see is like when people are surprised. When people are surprised, it means like, I think as a founder, as a CEO, you are not properly communicating to stakeholders throughout the process. So I think the less surprises, the better. When it comes to the board, look, it's a challenging place, because the problem with the board is like, look, the board wants the company to succeed. They want, they invested in the company, usually the board members, and they want the company to succeed. So they're on your side. Just typically they're on your side and they want the company to succeed. I think that the challenging part that I've always seen with the board is, a lot of times the board is an investor, and you at the same time want them to inject more capital in the business. And so how do you have a conversation? Like, think about it rationally with your investor. You're like, hey, I'm thinking about shutting down, but can you write us a check for another $1 million bridge? It doesn't go well together. And so that to me is a really, how do you like navigate that? And the answer is, I don't have a good answer there, because I think there's some board members that'll be like, well, if you're thinking about shutting down, why would I put another dollar in this? Right. I want like do or die founders. I want people that will sacrifice everything to make this going. I want to I want to see you cut off your salary. I want to see you do layoffs. I want to see you sacrifice before we sacrifice. And if you're saying like, oh yeah, we're thinking about shutting down, but can you write us another $1 million check? I don't know. I think some members might not see it. So some board members or investors might not see it so nicely. So that's the honest truth. I don't have a good answer there on that front. And then with employees, the thing I'll say is like, employees are smart, are really, really smart people. They're a lot smarter than a lot of people give them credit for. Hopefully you're hiring people that are smarter than you. And so employees know what the company's going through, even if you think they don't, even if you think that you're hiding it well. Like, employees are smart, really smart people, and we should all like give the team a lot more credit than they deserve. And so I think that if you think by not sharing that they don't know or they won't know, I think it's being naive. I actually think also people that don't know live in more fear. It's better to know if I prefer to know if I'm, have this problem than not knowing and like living with fear that I might have this problem. Right. And so I think in general, people prefer to know, even if it's painful to know, than the fear of not knowing could be more detrimental and be harsher. And the other thing is, one of the things that I've seen that's really unique is like a lot of companies that are at the end of the line and they're transparent with their team ends up sticking in there. Like, even though they know it's the end of the line, even though they know there's only X months of runway, they're like, you know, the team's bought into the vision as well. The team's been investing the last few years of their life. The team has equity in this company. Like, their equity is also going to get written off to zero if this doesn't work out. And so one of the things I thought was like really nice to see is how team members actually like stick around, even when they know that like we might be out of capital in 3 months, so we won't have pay. Like, if you're transparent and you give the team the option of like, hey, you can go look for another job, or we're going to continue pushing through, but know that it's risky. And a lot more times than none, I actually see the team sticking in and pushing through and caring a lot about the outcome, which you would think as a founder, like, oh, if I tell them they're all going to run for the hills, right? That's what you think is going to happen. And in most cases, I actually see that not happening, which is really awesome to see.
And Dori, you gave or shared a story about a company that had a wind down and some things came back to haunt them. With the remaining time, how about we have the exact opposite? Can you share a story of a company that did a wind down that actually resulted in maybe a positive, maybe there was a good outcome that later on it evolved to, or just, let's end on a good note before wrapping up.
Look, your question ties really into like our mission as a company. Like, we don't get excited about shutting down companies. Like, not what the team wakes up in the morning gets excited about. We actually get excited to enable entrepreneurs to do what they do best, which is build companies and achieve the impossible. And our mission is to give founders and entrepreneurs their time back, to give them the mind space and bandwidth to go build their next company, find their next job. That's what drives us and excites us. And so I think one of the things that we're really proud of is we did a survey last year, and I think we saw that 60 to 70% of the founders on our platform are already working on their next business while they're shutting down on our platform. And that's exactly what excites us. And so I actually want to tell like the story. There was a founder that came to us. They actually tried to shut down with another company at first, and they had a shitty experience. And then I'm like, hey, come to us. We'll do it for you. And like, I promise you, you'll have like the best experience ever. And so they came over to us. They used SimpleClosure to shut down. We did it in a fraction of the time for a fraction of the cost. We made sure everything was taken care of. Their investors, they actually distributed, they had like $1 million left to distribute back to investors. And so we helped them with that process of distributing funds back to investors and money back to them. And their investors had a really great experience. And they were like very impressed with like how that founder had managed the wind down and how it was taken care of properly and how it was done in a very organized and like professional manner. And it was done with like ease, that they actually wrote him his next check and his next company. So while he was shutting down, and they were really like happy with how he managed the process and was and how it was like handled, professionally. And, a lot of people say like you judge people's character when things aren't going well, right? When things are difficult, like, and this was a difficult time. He was going through the wind down, and we helped him take care of it. And so to me, that's like an awesome story, because his existing investors had such a good experience, because it was so seamless, because he had the bandwidth to deal with it. He was able to raise capital for his new company from the same investors because they had such a good experience. To me, that's like full circle. That's exactly like the entrepreneurship ecosystem, the founder journeys that we want. Like, we say it again and again, every failure is one step closer to success. It's just about, swings at bat, and you'll hit that and you'll succeed. And we want to enable you to give you the opportunity to do that.
Dori, that's fantastic. If anyone wants to learn more about yourself, SimpleClosure, what's the best way to go about doing it?
SimpleClosure.com. We have a lot of information there. We're happy to hop on calls with founders or investors that have portfolio companies that are considering, an asset sale or considering a shutdown. I'm on LinkedIn. I'm on X, Dori Yona. And we're here to help. We're happy to help just on a call and help kind of answer questions.
Fantastic. We'll have links to that in the show notes. And for our audience out there, well, I'm not the host of the Silicon Valley podcast. I'm an investment banker focused on mergers, acquisitions, growth capital, and secondaries. Feel free to reach out and connect with me on LinkedIn. And don't forget to check out our website, thesiliconvalleypodcast.com, where you can see this episode and all our archives. And with that, Dori, thank you for taking the time to be on this week's episode of the Silicon Valley Podcast.
Thanks for having me.